This is JJ Richa with Pismo Ventures, and this is the I guess the beginning, or we started the venture plan competition as of. Oh, I can't do this at the same time. It's doing YouTube at the same time. So hold on. I can't have it do that. Okay. I haven't tried it before, so first time. All right. So, anyways, so this is the Venture Plan Competition 2021 edition. We're doing this for the second time. We have a lot of great companies. We have great webinars. The webinars will be Monday, Wednesday, Friday during the month of October. So some great webinars coming up, starting with one of the greatest webinars with Jeff Koenig. So I'll let Jeff really tell you about what he's going to talk about. But before that, I just want to remind you that you need to complete your the questionnaire. The questionnaire, I sent you a link so you can complete it. The questionnaire it will take you about 30 minutes to complete, and there is no save function. So you just need to do it in one session. Many of you have already finished that, so that would be great if the rest of you would finish it up. Also, make sure you save all the dates for the webinars. Make sure you save all the dates for the live judging or the live virtual judging that are coming up starting on the 19th of October. Again, just to reiterate, other than what I sent you via email, round one is basically the questionnaire. So after the questionnaire, so based on the questionnaire and your application and evaluation, you'll move into round two. Round two, as you know, there are three different categories: B2B, B2C, and life sciences. And we are creating one more category or group. It's called wild cards. So the ones that can't make it, don't make it into these. So there's 15 of you, 15 in each category. The ones that can't make it, we have the wild card group or category, and 15 of you will make it into that have the highest scores. So we're giving second chances to the ones that don't make it directly into their intended category or the chosen category. That's it. So most important, keep looking at my emails. We keep sending emails on a regular basis, and then come join the webinars. And even if let's say you don't make it into round two or round three, you'll have access to all the webinars, also all the live judging sessions as well. That's basically it. If you have any questions, please do not hesitate to email us. And I'm going to give it to Jeff to take it from here.
Fantastic, JJ. Thank you for everything that you're doing for the entrepreneurial ecosystem, for hosting this event, and for hosting the competition. I will be looking forward to digging in on the companies and seeing all the great ideas again this year. So I'm just going to share my screen and let you confirm, JJ, that is coming across the way it should.
Yes, it is coming across.
All right, fantastic. Well, folks, let's dive right in. This is not going to be a how to do something talk. Okay, this is going to be a why to do something topic, because business finance is, in my opinion, the most challenging skill set for startups to acquire. Now let's start with a big audacious claim. Startup founders need to be able to mathematically demonstrate their likelihood of success. Is anyone here not already convinced of this? And I will try to monitor chats. There is at least one book I couldn't finish, written by a millennial entrepreneur who considers business planning and projections outmoded and obsolete. So I had to start actually asking this question in this talk instead of assuming everyone already agrees. There is some work by a psychologist and author named of Carol McBride, who doesn't work in our field at all, but ourselves, including our psychology, is something we bring into everything we do. She recently wrote an article that resonated with me, as it seems to explain an increasing frustration I'm observing among all parties involved with raising startup capital. McBride says there is a rising number of us who have, quote, the unreasonable expectation of automatic compliance with our expectations. The unreasonable expectation of automatic compliance with our expectations. Now, how might this show up very frequently in the startup funding world? When you started putting a business around selling something, you also started forming expectations, didn't you? Expectations for yourself, which you always comply with, right? It's safe to laugh at ourselves here. And also expectations of others. Do founders ever expect more enthusiastic customer adoption than they actually receive? Do you expect better or faster work from your first hires or your suppliers? Do you expect easier access to well-connected advisors you're hoping can help propel you forward? Or here's one, what about an easier time getting investors to write you checks? In fact, if you explain your ideas well, along with your good intentions, isn't it reasonable to expect customers and investors to support you? I mean, if not, why are you here? It's a waste of time to work hard and not get the reward you deserve. But that seems somewhat presumptuous, maybe entitled, or even narcissistic. So I need to modify and expand the big audacious claim. Startup founders really need to be able to demonstrate their likelihood of a success using numbers before spending a lot of time and effort doing it with words. So here's a question for you. Who here thinks they have used more numbers than they have words so far to convince others of their future success? Some of you may already agree with the direction of my thought here, and some of you may not, either on principle or because your experience so far seems to you to disprove my claim. Real life story from just this past Wednesday. I do some mentoring through a university NSF supported program, and at last week's session, 2 guest entrepreneurs were brought in to inspire an audience of new founders. And these new founders right now are working on customer discovery. Customer discovery, as you may know, tests founders' expectations about their product market fit. And during the open Q&A, the founder that I happen to be mentoring asked one of these entrepreneurs who's out in the world ahead of her, how did you measure whether your business would be successful before you launched it? Now, my Zoom video was off, so no one saw my reaction when the answer she got was, measuring isn't really up my alley. Just take that in. Understand now that this speaker's day job is the role of communications director in someone else's startup, which is what she was really there representing. But she also had launched a side hustle, a low volume online business with minimal capital needs, and she was her only employee. In other words, a very low risk startup. And that side hustle is what my mentee was asking her about. So after she gave this answer, she told a story about how great her product was and that everyone loves it so far. And 3 days ago, this was just on Friday, I was attending a monthly screening meeting of my home angel group. And there was a pitch from an experienced entrepreneur who has exited a past business successfully and spent several years after that growing an accelerator in a top 5 US city, teaching new entrepreneurs. But now she started a new thing, and she's asking for 7-digit capital, trading on her resume. She also came highly recommended by another founder that our group has already invested multiple rounds in. But after she left and we were in our internal deliberations, we did not vote to advance her to our main pitch meeting. And the reason for that is that while she had a great online marketing and customer engagement story, she had a weakly constructed revenue, expenditure, and capital plan. Gaping holes, really. So what do these two stories have in common? Which, by the way, I witness more examples of every week. Founders often believe that their great ideas and ability to sell them, which is critical, to be sure, is also enough on its own for customers and investors to comply with their expectations. You know, it's as if founders are saying, I'll tell you my company's story with words, and you give me significant numbers of your dollars. And herein lies the mismatch, particularly for the investors being pitched to. A financial offer requires a financial value proposition. If you can't explain in detail why the specific dollar amount of your raise is the right amount at the right time, with the right amount of expected ROI, and with real research supported and risk adjusted math, why should you expect investors to write you checks? Now, I'm hoping to get across to you today the wisdom of proving your business by the numbers before painting your future vision with words. In fact, your story will be easier to tell and sell if you write it after and build it up on the business financial model. If any of you were confident when you woke up today that planning and measuring by the numbers in rigorous detail isn't life or death necessary, but maybe now just might be experiencing a little doubt, I'm going to push you one step closer to the cliff. In business, asking someone to give you money based on a great story and your good intentions, but unsupported by well-researched numbers from the ground up, may be a completely legal, everyday, ordinary scam, in my humble opinion. Now, that's not entirely fair. I put it this way for its shock value. A real scam, of course, is illegal because it's intentional. Founders aren't trying to swindle, far from it. But if you pull the wool over your own eyes and allow yourself to imagine revenues and profits that you don't really have a detailed and logical case for, and then proceed to start selling hope to others, you pick the word we should use to describe that. Perhaps enabled, because others who have influenced your approach to this fundraising process have enabled you to accept that this is how startup capital raising works. Make some hockey stick claims, rush out to get the money, and then go find out what reality is. Isn't that more fun than getting discouraged by discovering potential game-ending risks up front? You be the customer for a moment. I want you to just try to imagine the anticipation of going and checking out a new eatery. And you don't really have a budget for how much you'll spend. You just want a good experience. So you get seated, you open the menu, and you see this. Any questions for your server?
That's pretty funny, Jeff.
Would you make a decision to buy without any idea about your expected experience? I mean, do you order random food dishes without being appetized by a description first? Of course not. Would you ask for money from your customers without giving them an idea about their expected experience? I bet you're all ready to tell your customers that they can't go another day without your startup solution. So then why would you ask for money from investors without giving them an idea about their expected experience? And what is that? What is ROI measured in? It's dollars. Investors don't want a description of what a dollar bill looks like. They want a rational number from you. Now, most pitches do not tell me what the company's target for my ROI is anywhere in the presentation. So I do often ask that question in Q&A, and I'll tell you how founders often reply. It's going to be great. Trust us. We're all going to do well because someone is going to buy me out for buku bucks. Just pay us now and your dessert will be coming out soon. Oh, well, then that's all I needed to know. What the founder is really saying is this. And guess what? Investors know you don't know. They aren't asking you to sign a balloon note with a big payment at the end that you're obligated to pay us. They're asking you to tell them what your best educated and research supported projection is. I mean, what are you specifically aiming for? Zig Ziglar said it like this. Now, for our context, in early startup phases of capital raising, I might change it, put it this way. But it might not be anything that actually feeds you and us. What did your math teacher tell you? Show me your work.
Jeff, there's some people on the phone, so you may want to read it.
Oh, well, it's a picture of our favorite Judge Judy, you know, the look that she can have on her face. And it says, when you tell your math teacher that you didn't think you had to show your work. And why did she ask you to do that? Well, because she needed to know that your approach to the problem followed logical steps and that you didn't just guess. What's wrong with guessing? Well, nothing when you're lucky, but that's an impossibly low probability in the very complex math of running a company. The probability of us not losing our money investing in your company is already low enough. A business financial plan can have hundreds, even thousands of variables, sub-equations and subtotals, adding up to the big numbers we are all seeking after. And these numbers can be in your operations planning, they can be in your customer KPIs and metrics and market planning, and then ultimately, of course, in the financial plan. Each variable in the business equation measures some single point of data, either about your marketplace or your company, and you need to analyze data collected and use it to propose a needed business strategic decision. And each decision creates dependencies to execute on them, which can require additional lines of data collection and analysis and decision making. Strategies that you choose need KPIs put on them so that you can measure the results of your decisions and continue to adjust your plans. As you do, your projections will change based on what you're learning. So many startups start with and never get beyond top-down approaches to planning, forming a theory about a big result from the most summarized data. And this is dangerous. Top-down is quicker and easier, which is why we like it. but is only useful for a general hypothesis. The real work is forecasting likely results from the bottom up to test that hypothesis. And what you learn by doing that is what builds your business intuition. A bottom-up approach is one that you can trust. But our natural thinking about this is so misaligned. Is there any acquirer of your company out there that's going to come and buy your business today, pay you the cash now, on the expectation then that in return, you will now go out and build the customers and the sales needed to justify that price? That's preposterous. Of course not. That would be a top-down business acquisition strategy, and it doesn't work. If 100% of businesses then are built from the bottom up, the first product, the first customer, the first employee, one day at a time, then shouldn't they also be planned from the bottom up? So do the work. That's my Judge Judy picture again for those of you on the phone. And now here's a picture of a piece of pie in the sky. Most of 1,000 pitches I've seen assumes a market share at exit based on nothing but a round assumption. But that creates an impressive value and also assumes fewer costs than experience dictates. Very, very rarely does any startup we invest in actually hit revenue or profitability milestones that the founders forecast, because there was never really any rigor or logic underpinning their assumptions. But the projections we are handed are big, designed to get us excited. And as I said, it's an unwitting, non-criminal scam that happens every day. The fact that some founders get lucky shaking money out of the wallets of investors who are easily either cow-eyed or didn't do their diligence isn't justification of this as a systematic approach to early stage capital raising. But if this is your preferred approach, I say you're better off buying lottery tickets. I'm at least one investor that won't give you money because you entertained me with creative fiction and are convinced of your own luck. This was not the title of the talk today, How to Construct Your Entire Financial Business Strategy in a Day, by no one. This isn't a how-to talk. Frankly, no one can teach you how to do this in a single day or even in a month. But I will give you some insight into how deep you will need to go to do it well. There is no universal template, okay? So what you're about to see, if you try to take notes or write all of this down or take screenshots, it's not going to help you. Just absorb the concept and acquire an appreciation for the level of detail required. Financial modeling varies widely anyway, according to the sector you're in, from consumer packaged goods to software to deep technology. So every detail of your business and the opportunity must boil down to a number, ultimately expressed financially. Revenue achieved at one or more possible exit points cannot be projected without getting there annually, which requires projecting monthly. That requires measuring your geographic population of customers and their rate of annual participation so that you can arrive at your actual market size, but you'll need to jump out to do an entire exercise in marketing planning to project your market research in order to plot your expected market share. And then jump out again to do an entire sales force or distribution planning exercise to project leads from your marketing campaigns per period and business cycle, divided by sales headcount, times accounts, each one managing without burnout, including and reducing leads, down to follow-up calls that result in a fraction, who get samples or demonstrations with additional Q&A, leading to proposals or offers that may require contract or price negotiations so that you can determine a successful closing rate at an average selling price per unit, which you expect to realize per product or service offered, plugged back up into your revenue model per period and cycle, then projecting repeat purchases, contract lengths, or renewals and customer churn, then building in periodic multipliers like changes in customer population over time, price inflation and changes, cyclical seasonality and where marketing and scaling puts the company on its market research growth curve to maturity, which then relies on revisiting marketing plans to test your sales assumptions and leads generated with advertising, per campaign, per channel, per delivery, using someone's ad buying expertise to estimate number of eyeballs reached, reduced by number of lasting impressions made, leading to responses to calls to action, turning into leads, everything subtotaled and totaled, and assumptions at each variable of these equations captured and stored so that they can be recalled and compared to reruns of the exercise, which you will do multiple times upfront per distinct line of revenue and repeatedly as your business operates and replans continuously for upcoming business cycles. And that's just the tip of the iceberg for revenue planning. Now, we need to plan for direct costs of selling and how it's expected to change with volume growth until one or more exit points, broken down annually, which requires projecting monthly, all per product, per offering. Then we need to plan for executive and administrative labor costs, imagining the full organizational chart until exit, and estimating the timing of every hire until then, including upfront recruiting and training costs, and then ongoing costs of compensation with benefits and raises. Then we need to plan for location costs at various levels of production capacity and number of persons employed like rents and utilities and office maintenance. And we still have non-labor overhead administrative costs down to paper and pencils. Each of these expense categories have multiple lines and need to be comprehensively identified and well organized. And there are some special categories I haven't even mentioned. Maybe by this point, we have enough logic-backed research data with historical assumptions captured to produce detailed pro forma profit and loss projections. If this is like drinking through a fire hose, we're not done, because profit and loss does not equal cash flow, because we need to anticipate cash required to sustain growing operations each month ahead of and separately from cash generated by sales with a healthy buffer we call a cash runway, taking into account cash needed to invest in non-expensable assets with long-term equipment, for example, per period when each asset investment is needed. These cash outflows need to be offset by cash inflows, including cash coming from founders, which should be significant upfront and re-upped over time, adding in additional cash from debt sources over planned periods of time, and for fast growth, scalable startups that can't do it with only those resources alone, the need for outside equity investors at various pre-planned stages until the planned exit. All these things together create the capital plan. Now, why is any investor going to put faith in your plan without clearly seeing that you have planned to reward that faith? So you need to plot what you expect in enterprise valuation per round and at the end, so that with all of that information, we can project the capitalization table per round and at the exit, which you need fully calculated so that when you are out raising funds in a given round, you can inform investors what their expected ROI will be for their investment in that round. Remember that question I often have to ask you in your pitches. Simultaneously, you'll be tracking your own ROI. And still, at the end of all of this, you need to understand that any of these variables that just flew by you may require dozens of additional sub-variables, researched data points, and calculations unique to your industry, business model, or company. Every number can influence multiple other numbers like gravity. If better information causes you to change one part of the financial plan, others may need to change to remain sufficient or maintain sufficient cash supply. which is the real name of the game. It's incredibly rare that your first bottom-up run at modeling your business, if you're realistic and honest, is going to show you enough enterprise value at exit. Wouldn't you rather know that in the beginning? Isn't it better before you launch to pivot now and go back, possibly as far as redesigning your core customer value proposition so you can increase the value you are creating and the price you can charge for it? All along the way, extensive market research is required to ensure product market fit, adequate customer willingness to buy at your target price, adequate supply of all your other inputs and their costs, from goods to services to human resources. This is managing your business as a business and not doing only what you probably default to, which is working on your solution idea. Most founders are natural CTOs or CIOs or COOs. And what they lack, what's often missing, are the CFO skills. Finance professionals are strategic financial planners. If you don't do strategic financial planning with the same rigor you apply to your operations planning, your chance of business failure runs well into the 90s. And why wouldn't it? If someone without your experience tried to slap a solution like yours together operationally, without your level of expertise, do you think their solution is going to work? Well, for the same reason, even when your solution is better than another one that doesn't work as well, but it basically works, if that competitor knows how to masterfully plan for profitability, you are still likely to lag behind, even with a better solution. Being the best is not a golden ticket. Everybody take a big breath. But measuring and financial planning isn't up my alley, you might say. I don't know how. I don't know where to start. I get stuck. I don't know what I don't know. Appreciate the comment. Look, I know you're an overwhelmingly sympathetic company here. Most first-time founders, and even many who aren't at their first rodeo, don't know how either. And this is a big reason why we struggle. But there are people who do know how. Yet you all have a tendency to acquire the CFO skill set on your executive teams last. You hire operations, sales, legal, accounting, and the receptionist before you finally get a finance professional. And by then, you've burned a lot of cash. Why didn't those who helped you with starting up tell you about the crazy level of detail needed? Because most of them excel at teaching and networking. That's their skill set. That's why they teach. They have never gotten that deep into the numbers themselves, and they don't ken it any better than most of the rest of us. As vital as the numbers may be, strategic finance is a specialty area. So what I hope you take away from all this, if it's never been done, someone needs to break your business down to every dollar that you hope to flow through it and help you build a business model that absolutely convinces you it won't run out of cash, pivoting as necessary to achieve that. And if you don't have this skill set yourself, hire it in, outsource it, whatever it takes, and build the cost of that into your business as just one more needed input. Then you can answer investor questions smartly and authoritatively with confidence and not feel like a fraud. And so, yes, the answer to the last question is you can absolutely use advisors. You can outsource this. Just get this skill set into your wheelhouse. as you seek to fill in this need, there's a pit I don't want you to fall into. Except in the rarest cases, your accountant is probably not the answer. Accounting and finance are two different disciplines, though they use some of the same data. Accounting shares the same root word as accountability. Who do you owe? Accounting examines the past, but finance uses past and present financial data to help us make strategic decisions about the future, leading to outcomes that haven't happened yet. So where the accountant plans your defense based on what has already happened, finance plans your offense. Finance doesn't just calculate, it gathers intelligence, not unlike the military, anticipating business battlefield risks and moving the resources into place to overcome them. So if you're the CEO and not just a founder, then long-term, you aren't supposed to be the chief financial planner or fundraiser or scientist or head of marketing and sales. The E for executive doubles as the E in execution, as in execution of plan. You need to depend on other department heads with specific skills to build a cohesive plan so that you can approve and execute. The CEO needs to know what resources are needed by the company and acquire them, which is what I'm asking you to do. So let's close with this insight, and then I have plenty of time for Q&A. Investors often say it's not the horse, your business idea, it's the jockey, your management team and your board. Investors chiefly want to see well-formed teams that demonstrate all the necessary skill sets, including finance, earlier on than you probably thought, so that we can be confident you can get yourselves and us to the finish line. And I'm also aware that tapping and assembling the right team is at times frustrating and challenging too. But hitting a home run with a business startup was never easy. That's why it pays so well when it happens. We operate in an economic reality of scarce resources, requiring exceptional cleverness and ingenuity to put it all together. If everyone could do this, it would no longer be special. So remember this. Don't hold an unreasonable expectation of automatic compliance with your expectations. You need to show your work, that you've done enough of it that's worthy of investors shifting their focus off of thousands of others a year to focus on you. So let me hear your thoughts.
Thank you, Jeff, very much. All right, so we have some in the chat, we have some in the Q&A. So if you have any questions, it would be easier to put them in the Q&A. That way we can it would be easier to go through them in that manner. All right, so we have, let's go through the chat. Can you see the chat, Jeff?
Yeah, you bet. You want me to start with the chat window?
Let's start with the chat.
So we did see Thomas ask us about being able to get those resources out of house, and yes, you can absolutely do that. And then Melanie asks for those cold mailing, Twitter, doing LinkedIn messaging, etc. At what point in the conversation should we share this level of depth? Okay, so what I'm imagining there, and I sometimes receive these in LinkedIn, rather than come through the usual funnel of applying to an angel group and getting a meeting, you're perhaps trying to farm your presentation out directly to individuals that you can find through social media. I do know that this goes on. I don't expect it to be terribly successful. I think it's one of those things that if you pitch to 10 angel groups and get an investment from 2 of them, that's going to be significant for you. If you send something to 1,000 people on LinkedIn, I don't know, do you get 2 responses? I know I don't normally respond to them. Just because if I was able to let anybody, when they wanted to on their timing, to come and ask me for 15 minutes, 30 minutes, an hour to just focus on considering them, I can't handle that. I couldn't possibly keep up with that. And if I did it a time or two, then more people would come, and all of a sudden I would no longer own my own schedule. So my recommendation would be to ask yourself, why are you doing the reach out that way? And are you willing to come through the normal channel of applying to well-formed groups or micro VCs and really getting the meetings and allowing yourself to be vetted before you get the meeting?
Great question and a great answer. And it's really true. I mean, I hear a lot of times like, let's just send it to as many people as we can and see what happens. And most people just, like just said, they don't have time and they get bombarded, and they would like to get some pre-vetted opportunities first.
Mm-hmm.
All right, so can you see the Q&A, Jeff?
Yeah, I see Kate is asking about those that may have, as investors, may have a predisposition to discounting financial projections from women, but I'm going to even extend that to any group that could be race-based or something else. This has been an interesting question that I've fielded, being a part of 5 different angel groups over the years, also being involved in real estate investing and other sectors. And it's tough for me to answer, and maybe it has something to do with the way that we surround ourselves with people that are like us. But I have never witnessed a direct instance of an investor sitting next to me that I know behaving in this way. Now, that's not to say that it doesn't happen, okay? Because that would be an absolute. And obviously, people have had these experiences or believe that they've been treated this way, and so it happens somewhere. Not being one of those people and not surrounding myself with one of those people, I don't even know how to talk to people who would do that. In my book, the numbers speak for themselves. I don't care who you are. In fact, if I never met you, but somehow my angel group is saying, this is a good deal, look at the deal, and I would dive into the numbers and the data and things, and I would render an opinion based on what the data is telling me. And then if I met you after that, I don't care if you're green and come from Mars. If it's a good plan, I like it. Okay. So maybe my best answer is, in time, with generational turnover, whatever degree of this still exists, hopefully will die with it. So.
Yeah, I agree. I don't know of anyone, at least I've been doing this for a very long time, 13 years or so. I don't think I've met anyone that cares, but I do hear it. So it's not like I don't hear this. I do hear it all the time, but I don't know of anyone personally. All right, so that's from Kate. All right, Kate has another one right below it.
Yeah, there's a follow on there, and I appreciate that, in terms of things like direction of questioning and maybe perceiving a difference in that. I'll tell you, there is this one bias that is common among investors that I invest with, and that's husband-wife teams. Now, in that case, it's not really even a gender thing, or we see teams of families, brothers and sisters, things like that. We're really concerned about family teams because it puts an added stress on home family life to also all be in business together, making those decisions all day long. And there is data that supports strongly that family teams often have more problems getting to the end because of breakdown along the way. Now, I have invested in a few family teams that seem to have a great dynamic and work really well together, and I haven't been disappointed. So, like any other bias, it can never be absolute. It's just a factor. But in terms of direction of questioning, one of the things that I really try to warn anybody about, because, this could come from you're a student team, you're very young, you're coming out and you're raising money for the first time, and you perceive that the questions you're being asked about who's the adult in the room going to be, when are you going to find an experienced CEO, things like this. They could perceive that easily as some sort of ageism, right? Discrimination against their youth. Okay. But that's not the motivation behind it. The motivation is still the practical, brass tacks, hard real world facts that experience counts. And that's why they're being asked those questions. So, take as broad an approach as you can to hearing those questions and give the benefit of the doubt to the asker. What could the legitimate reason for the question be? And try to keep, an open mind in that respect.
Thanks, Jeff. So I'm sure you guys have a lot of questions, so don't be shy. Go ahead and post them here. And I'm hoping that you would ask Jeff some tough financial questions, not accounting.
Stump the CFO.
Some CFO stuff, right? So ask him questions. I'm sure you have questions on that. And if you want to ask the question live, I'll bring you in I'll make you as a panelist, and then I can allow you to talk and have your video and audio. So if you have video and audio ready, just raise your hand or just put it in the chat, and I'll allow you in. So that may be easier than just typing a bunch of questions in. Okay, Thomas is next.
Mm-hmm. Yeah, Thomas is asking a question about cost for these kinds of services. And remember what I said about accounting versus CFO, okay? If you go and get somebody whose work is as a CFO, outsourced CFO, and you rely upon them to do many of your accounting or even your bookkeeping functions, then you're going to be overpaying. And the reason is because you are paying somebody at the rate of a much higher level of skill in strategic finance to do low-level work. And that's one mistake that I do see a lot. So make sure all of your daily and weekly, data entry and basic measurements with numbers tasks are done by an hourly bookkeeper. Make sure that your tax return filings and other regulatory compliance issues are handled by your accountant, and that's at a higher rate but far fewer hours. And make sure you use your CFO for the skill that they really have, which is to help you with the planning. For instance, a lot of my clients spend very few hours per month on me because essentially what's happening is we're meeting, I'm thinking strategically with them, and I'm directing them. Here's what you need to go do next. Measure this, calculate that, form some conclusions as a result, and let's talk again. And so my hours are in that way very limited. I'm not going to get into your QuickBooks. I'm not going to make entries for you. I'm not going to build your tables. I'm not going to do your projections. I want you to learn how. I'm just going to guide you.
So like Jeff said, he said it in multiple ways. Accountant bookkeeping is about what already happened, and CFO is about what's going to happen or the direction of what should happen. So they're completely two different functions. Thomas, you're live. Go ahead.
Yeah, I think you answered most of it. Thank you. It's very educational. I think my question's around how far do you take it? And I think you'd mentioned it a bit with your meeting month to month, but for like an early stage startup, maybe a little bit of revenue, you don't want to, you got to pick where your dollars go. Does it go to generating more revenue or, CFO services that help you tell your story? So maybe a little advice on the balance without breaking the bank.
So I give an entirely another talk on this problem of undercapitalization. So the question is kind of like saying you have a new baby, the baby needs diapers and bottles and needs clothes to be warm, but you can't afford all of it at the same time. So which things should you not give the baby? Okay. If your business has a set of needs and all of them that must be met, And if you're in a position where certain critical needs can't be met, then you are undercapitalized. You don't have enough cash. And that is a function of the planning. You needed to plan for all of your cash needs, and you needed a capital plan to acquire the financing ahead of needing to pay for those needs. So go back to your capital plan, determine what your true cash needs are, and recapitalize your business. You know, that's not an easy answer, but it's the right answer.
All right, thanks, Thomas. Anything else? All right, anyone else that would like to, ask the question live, please do so. Just raise your hand and I will bring you in. All right, okay, so Douglas, how about Douglas?
Yeah, I see Doug's question. He's asking about having built out a financial model based on benchmarks for a sector for B2B SaaS companies and use of proceeds in early stage. Is that a bad idea? And some follow on about experimenting and product market fit. So no, that's not a bad idea at all. In fact, there are those business ideas that are so novel, relatively new, maybe very new industries, or maybe they're creating a new need, a new customer problem to solve, that you don't have much history from competitors or from an industry to glean. So one of the deepest skills of a good CFO is the ability to choose comparisons, comparative parallel industries that aren't the same. They may not produce the same thing, but at an operational financial level, they can be expected to behave the same way. Okay, so let's say that you were developing the very first social media platform, all right, and this had never been done. And so you were thinking, gee, we have no financial research. But if you had sat down, thought about it, and decided, okay, what do we expect the characteristics of social media to be? Well, it's going to be mano a mano, person to person. Obviously, there's a freemium component. At some point, we're going to begin to sell advertising for revenue, or we're going to start charging membership rates for revenue. Well, is there any other business that has been, industry that has started before with those similar characteristics? And certainly you could find earlier instances of software companies that started with freemium models, built person to person, built a following, and you could use comparisons, things like growth curves and amounts of money needed to get established and exit as valid research. So what you're doing, using a sector of information to chart certain curves and behaviors and apply it to yours, if you have similar characteristics or expect to have similar business characteristics, is very valid. And you should try to get as many market research sources as you can and compare them so that you can find where the middle is that you're likely to be able to count on.
Okay, go ahead. Dave is next, but again, I will ask you to come live if you want to. Go ahead, Dave.
David asks what the formula is for a SaaS business model with product market fit, ARR under $1 million as an angel for a realistic valuation. Aha, okay. So if I had all of that in my head, I would probably be brilliant, and I'm definitely not. But I'll tell you this, what we know as angel investors is where to get opinions. And so if you come to us with a specific industry and a specific model, and I'm unfamiliar, and somebody else in the group didn't already build an exit of business in that space or know that space very well, well, there are others that we can turn to. In fact, I know of one group, I get their newsletter, I can't think of their name right now, but they specifically deal with SaaS and valuation of SaaS companies. They track it, they metric it, they're doing research all the time. Sometimes I download and read their reports just to try to stay vaguely familiar. I've never grown a SaaS business myself. I was in other things, and so it's not my deep well of experience, so I have to rely on another source like this. So all I can tell you is I'm going to take your pitch, I'm going to take your plan, I'm going to get some initial thoughts, but then I'm probably going to get some help to evaluate it.
All right. Patty.
We must have lots of SaaS folks with us today. So ROI for SaaS based on research 10x seems conservative and fair. Recent feedback is driving figures, though, closer to 20x thoughts. Yes, we see these sorts of patterns in real estate and lots of other things too. And I am aware of those particular metrics. I do see those. 10x has seemed to be a rule of thumb, maybe for the last, I don't know, 5 years to a decade on SaaS company exits or valuations. Yes, they are pushing up, as is a lot of other sectors, as is real estate. I mean, I was buying apartments at 150,000 per door only 2 years ago, and now I'm seeing prices approaching 300,000 per door. And what's causing all of this is a lot of extra capital coming into the marketplace due to very loose monetary policies around the world post-pandemic. All this extra cash is looking for a place to be invested, and so it's a seller's market. It's pushing prices up on everything. How should you view that then? Well, I would not build your plan based on 20x. And the reason is because what goes up comes down. Markets are cyclical. And if you're early stage and you've got 4, 5, 6, 7 years before an exit is realistic, the whole economy could be very, very different. In fact, a well-known economics outfit by the name of ITR out of Kansas has been forecasting a 2030 depression for a long time. So if your exit is going to be closer to 2030, we could have a very different economy. Be conservative is my advice.
All right, thank you, Jeff. Great answer. All right, we have Andre that wants to have a live question. Go ahead, Andre.
Thank you so much, Jeff, for the information. Thank you, JJ, for the opportunity. Let's say you're entering into a new sector such as SAMD, software as a medical device, and you're trying to gain research that will speak to the investors in terms of numbers. What research is considered reputable? Because you know out there you can end up paying thousands of dollars for research that's not necessarily viable, et cetera.
No, it's a great question. There's actually a few sub-questions within that. So the first thing is to make sure that we understand how we are supposed to look at your company, because software companies are valued differently from medical device companies. And so are you truly a medical device with a software component, or are you truly a software company with a hardware component? And those nuances become very, very important. Now, we're not going to try to ask and answer that here, but we have to make sure we understand that, if you come forward leading with, we are software as a medical device, is that for marketing purposes, or is that actually how it is back in the factory on the ground? Your valuation metrics and your research should mirror what your most central core value proposition is, what you're actually selling. Now, let's say that you're truly blended, like it's really 50-50 and you're doing something that's a fusion that's pretty unique. Do both. Study how medical device companies are financed and grow up and are valued, and the same with software companies, and compare. And if there's a big variance, like one thing is really, really promising financially and the other thing, well, investors are going to pick up pretty quickly that you're just picking the most advantageous one to fundraise on. So you've got to be honest. You've always got to be honest and upfront. You would rather people discover surprises than discover negative information when they're looking into you. Okay. So you may just have to paint both pictures and say, look, folks, we're trying to do something new here. But, if you like the problem we're solving, then, give us a fair shake.
Thanks.
Thanks, Andre. Anyone else? Question or come on live with a question? I will give you a couple of minutes here if you have any more questions. Meanwhile, I'll remind you that there is another webinar on Wednesday, same time, 9 a.m. Pacific time. And it is presented by the president of Tecos Angels Orange County, David Friedman. It is how to tell your story. It's a really important subject because it really, other than telling your story by word versus by number, you need to be able to be succinct and be able to tell your story very quickly, get to the problem very quickly, and get to the solution very quickly. So the investors that are in the room, they understand immediately what you are doing. I mean, I could tell you, Jeff and I, and many of our colleagues, sometimes we sit there and then someone is telling us, and then 5 minutes into it, and we still don't know what they're doing. And that's really hard, because then you lose that concentration, and then you don't want to listen anymore. And usually we don't interrupt people when they're presenting, but on a couple of occasions I've interrupted because I just didn't know what was going on. So
JJ and I know David well. He's going to do a great job with that topic, but remind him that I came first. So yes. Now you know why.
I will do that. There is another great webinar, and it's on Friday, and it's basically how to build your business canvas, and it's going to be presented by Bob Stacy, and Bob also is a member of probably 4 or 5 angel groups across the nation. Very experienced. I would not miss that also. So a lot of great webinars across the entire month of October. So I would not miss any of those.
Bob is brilliant at Canvas, guys. Don't miss this. Bob is really good at it.
Yep, very true. All right, I don't see any questions. I don't see any hands being raised. So Jeff, thank you so much
My pleasure.
for doing this. This is really, really great. I really appreciate this.
Well, I hope everyone has a great week, and we'll see you again.
Yes, and finish up those questionnaires. If you have not done your questionnaire, please finish your questionnaires, which is the startup questionnaire. It's different than the application that you filled out. Thank you very much. We'll see you on Wednesday. Thanks, Jeff. Bye-bye.